Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 that has recently retraced from the Fibonacci retracements of the 2022 correction. It has taken out the 50% retracement level. So the market essentially with this rally has retraced over 50% of the correction that we had throughout 2022, a correction that caused a historical amount of panic and concern amongst investors. Throughout the first 6 months of the year, it was retraced in just 2 months. That does go to show you the power that market recoveries can have, or even just bear market rallies. They can be incredibly powerful. Volatility can get very extreme, from the market panicking irrationally about a CPI number right here, and just a few weeks later getting overly optimistic on another CPI number that really shows you the power of emotions, of investor psychology in the market. It really is an impressive sight and a really exciting moment to be in the stock market. Now in this video I want to discuss a very specific chart that I'm seeing a lot on Twitter, on YouTube, or really anywhere online. It's the personal savings rate in the United States that has been incredibly low over the past few months. Ever since March 2022, really when you had gas prices reach record levels, the savings rate has been incredibly low. So a big narrative behind that, people are struggling, the consumer is struggling because things are getting too expensive, inflation is getting out of hand, and so they're not able to save anymore. In fact, if you zoom out on this chart here, you can see the savings rate is down to the same levels that you were at around the great financial crisis. The last time a savings rate was this low was around 2007 to 2008. And you could argue that the big cost behind the 2008 financial crisis is that the consumer was incredibly weak leading up into it. And so that really triggered the financial collapse, as the consumer was just way too weak to endure that type of macro environment. So the question is that the same today? Are we in the exact same position that we were in right before the 2008 financial crisis? I think that's a relevant question considering where we are in the market at resistance, overbought on the RSI. If we are indeed about to enter a hard landing recession with a collapse of the banking system and rapidly rising corporate defaults and a collapse in the high yield bond market, well, you would want to sell right here. So that's the question that we're going to be answering in this video. If you are interested in following these crazy markets with us, don't forget to smash that subscribe button. Also, if you enjoy this episode, you learn something new, and you appreciate the time and effort that goes into producing these videos, don't forget to smash that like button as hard as you possibly can without smashing your phone or computer screen. Now, the way we're currently looking at this is not by just watching the savings rate, because this is just telling you how much people are saving right now, this year, this month. It doesn't actually tell you how many savings they have in their bank account and how much room they have before they're really starting to struggle. And you can see here throughout the pandemic, between February 2020 all the way to April 2021, so a full year, we had the personal savings rate go absolutely through the roof to levels that we have not seen ever on this chart. So this is a pretty impressive level, and you can actually see that the savings rate stayed at unprecedented levels for a full year. So we have to ask the question, is this relevant, and how much money was actually accumulated by the consumer in this region? And the result is around $3 trillion, right? So that's a big amount of money that was exacerbated by the fact that people were really at home not doing anything for a full year. And you had stimulus, easy money, and so that led to a nominal excess personal savings of around $2.5 trillion by the end of the pandemic. And this is a chart that we've shown several times before on this channel because we think it represents the current macro environment so well. When you put the savings that we had throughout COVID relative to the estimated spending in 2022 and 2023, it tells you that the consumer is in pretty good shape and in a lot better shape than what the consumer was like leading up to 2007. Because you can see here, leading up to 2007, here between 2005 and 2007, you had the savings rate sit around 2.5% for a couple of years. So very, very low, historically low amount of savings leading up to the 2008 financial crisis, which is not at all what we had over the past couple of years. Yes, it's down now. Yes, it's very low now, and people are likely digging into their savings, but they probably have a lot of room to still spend. And as soon as we realized this, we came up with those charts back in May or June, I believe. We put the consumer discretionary sector, XLY, on our trading watch list on June 14th, because XLY, consumer discretionary, had been the worst performing sector in the SP 500 throughout 2022. And yet we had these charts telling us that the consumer was actually in a great shape. And so we bet on the consumer discretionary sector right here. And the idea behind the watch list is that we give regular updates on the specific levels, specific entries, targets that we're looking at for the trade, and we give frequent overviews on that particular idea. But we like to have all of the trades on our watch list to be backed up by fundamental research and really a macro vision of why we think it's an attractive opportunity. And then we dig frequently into the technicals, internals, the sentiment, and see where the most attractive opportunities, and see exactly how we can take advantage of the risk reward, giving you guys more visual charts and actually precise targets, precise returns with precise time frames. If you think that's a service that you would be able to take advantage of and you're interested in testing it out, see how it feels, see how it works, we do have a free trial on our website that's designed to let people just try out the service completely for free, get access to all the research, all the trade and investment ideas, no questions asked, and see if that's the service for you. So click on the link down below if that's something that you'd be interested in. Now, why am I talking about the consumer in this article? Why am I talking about this healthy consumer balance sheet? Because I personally think that's a big part of what's going on here in this rally. So we had a couple of good inflation prints over the past couple of months, or at least weaker than expected. It's still very high inflation levels, but it seems like the market is starting to get surprised to the downside by inflation, which is definitely new and hasn't happened in quite some time. So what the market is saying here, the narrative that's driving this market is, if inflation's coming down, well then perhaps the Fed is going to be able to back off the brakes at one point. It's going to be able to start pivoting sometime soon. And if they do that, well, you've got a very strong consumer that has a lot of money on the sidelines, that at least on the balance sheet is very strong, that would start spending again very intensely if the Fed were to pivot and bring that easy money in again. And so the market for me is basically pricing in a soft landing, because it can be optimistic and start pricing in the recovery and the strong company earnings that are going to follow a Fed pivot. So that's what the market is currently pricing in right now. But the only way that can continue is if the 2-year yield, which is basically the market's anticipation of the Federal Reserve's monetary policy, it needs to stay down. It needs to stabilize, right? And you can see there's a very strong correlation between the 2-year and the S&P. This is the big surprise in inflation and what led the 2-year very high in June. And you can see the stock market bottomed just a couple of days later. The 2-year yield has been stabilizing. You've had a very strong market recovery. The 2-year yield, so Fed policy basically, or anticipation of Fed policy, is what has been driving the market and is still driving the market. The top in the stock market was caused by a rapidly rising 2-year yield right here. The top in March 2022 here was caused by a rapidly rising 2-year yield, and the bottom in the stock market was caused by somewhat of a stabilization in yield right here. So again, why am I saying that? Because look at what's been happening to the 2-year yield very recently. It's been climbing up again. It's been moving higher again. Now, for now, it doesn't seem very dangerous, but if this trend continues and you continue to see the 2-year yield climb higher over the next few weeks, what do you think the S&P 500 is going to do? It's going to retrace, probably part of this move. Let's front run this big Fed pivot to, oh wait, perhaps the Fed pivot is not going to come as soon as we expected it to, and so we need to retrace and pull back a little bit. This is why the market never goes in a straight line. It doesn't go straight. It goes up and down, bounces up and down as the market reconsiders how far it went initially and kind of reprices itself. And that's why you have trends instead of straight lines in the market. And we could very well be there right now. We're not in a rush for seeing the S&P 500 higher. Our target is looking out 6 to 12 months. It's a lot higher at 5,200, 300 points, although we are now considerably closer to that than just a few weeks ago. So I'm not used to having such a reasonable target. But in the meantime, we've had a big run up here. We have some of the key indicators like the RSI, if it's going to load at overbought levels here. And so it's generally a poor risk reward here in the short term. It's really not an objective entry here at resistance and overbought. So I think there's a reasonable chance that opportunities could appear over the next couple of weeks that could offer an objective long opportunity if you do see the market get spooked by, for example, a rising 2-year yield or maybe even a breakout in oil. Those are things that could spook the market in the near term. So you could see some objective buying opportunities just over the next couple of weeks, which is why you should check out our free trial at gameoftrades.net to see those support levels, those maximum drawdown levels that we're currently looking at on the S&P 500 and on all sectors that we find attractive right now. In the short term, we're not looking to predict anything. In my opinion, that's a fool's game if you're really basing your entire strategy on a short-term move, betting everything on a pullback. I think you can get disappointed with that type of crystal ball mindset, as if you know exactly what the market is going to do in the short term. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. Don't forget to smash that like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.